It's one of the most common and most important financial questions a person can ask themselves. You've worked hard, you've saved up some money, and now you're ready to put it to work. But where exactly should it go? We live in an era of unprecedented choice and, frankly, unprecedented noise. Every day, we're bombarded with advice from every corner of the internet. Financial news channels flash dizzying charts, social media influencers promise the next big thing, and even well-meaning family members offer tips that might be decades out of date. The pressure to make the right choice can feel immense because the stakes are high. This isn't just about numbers on a screen, it's about your future, your goals, and your financial security. The modern investment landscape is dominated by three major contenders, each with its own powerful story. There's the stock market, the traditional engine of wealth creation, representing ownership in the world's most innovative companies. Then there's real estate, the tangible asset you can see and touch, offering the promise of a place to call home and a source of passive income. And finally there's cryptocurrency, the new digital frontier, a volatile but potentially revolutionary asset class that has captured the imagination of millions. So, which one holds the key? Should you bet on the proven track record of stocks, the tangible security of property, or the explosive potential of crypto? To cut through the human bias and the emotional arguments that so often cloud this debate, I decided to approach the problem from a different angle. I put this exact question to three different, advanced artificial intelligence systems. These are large language models, trained on a colossal amount of financial data, market history, economic reports, and academic studies from the entire internet. My prompt was specific. Assuming a 10-year investment horizon and a moderate risk tolerance, construct a diversified portfolio using stocks, real estate, and cryptocurrency. Justify your allocation percentages and explain the role of each asset class. I then took their independent analyses, cross-referenced their conclusions, and synthesized them into a single, unified strategy. The answer that emerged is probably not what any one of those communities will tell you. Why is that? Because every investing community, to some extent, lives in its own echo chamber. They develop a kind of tribalism, convinced that their chosen asset class is not just the best, but the sensible option. This conviction is reinforced by shared successes and a collective dismissal of any outside criticism. Venture into the world of crypto, and you'll find a passionate, almost evangelical belief in the power of decentralized finance. The prevailing sentiment is that traditional financial systems are obsolete, and that holding anything other than assets like Bitcoin or Ethereum is a missed opportunity of historic proportions. To them, you're not just investing, you're joining a revolution. They see the volatility not as risk, but as the price of admission for life-changing gains. Talk to a seasoned stock market investor, however, and you'll get a very different perspective. They'll point to a century of data, to the compounding growth of the S&P 500, and to the fundamental principles of value investing laid down by legends like Benjamin Graham and Warren Buffett. From their point of view, the stock market is the only arena where you can truly own a piece of global economic growth. To many of them, crypto isn't an investment. It's pure speculation, a form of digital gambling with no underlying value. And then there are the real estate investors. They'll tell you that stocks are just flickering numbers on a screen and crypto is imaginary internet money. They believe in the tangible, the physical, the asset you can stand on and rent out. For them, the combination of appreciation, cash flow from tenants, tax advantages, and leverage makes real estate an untouchable asset class. In their eyes, everything else is simply inferior, a riskier and less reliable path to building real, lasting wealth. Each of these arguments is compelling. Each community has its success stories and its true believers. But if everyone is shouting that their way is the only way, how do you find the actual truth? That's where the AI's objective, data-driven perspective becomes so powerful. The truth, per this synthesized AI analysis, isn't about picking a winner. It's about understanding that each of these assets plays a unique and vital role in a well-constructed portfolio. The answer is more nuanced, more balanced, and ultimately, far more useful for the average investor. So, let's break down that strategy. Let's start with the bedrock of modern wealth creation for the average person: stocks. Why? Because they master the trifecta of accessibility, liquidity, and diversification. In today's world, you can start investing with just a few dollars from an app on your phone. The barrier to entry has never been lower. This is what we mean by accessible. Liquidity is just as crucial. It means you can convert your investment back into cash quickly, usually within a few business days. This flexibility is a powerful advantage, giving you access to your money when you need it, unlike other assets that can take months to sell. And the most effective way for most people to own stocks is through low-cost index funds. Think of an S&P 500 index fund. You're not just buying one company. You're buying a small piece of the 500 largest, most influential companies in the United States. You're betting on the long-term growth of the entire economy. Historically, that has been a very good bet. S&P 500 index funds have returned an average of around 10.5% annually over the past 50 years. Now 10.5% might not sound like a lottery win, but this is where the magic happens. Compound growth. Let's use some simple math. If you invest $10,000 and it grows by 10.5% each year, after 10 years, you'd have over $27,000. But let that same $10,000 ride for 30 years, and it could grow to nearly $200,000. That's the power of your earnings generating their own earnings, year after year. This is achieved through passive management with incredibly low fees, allowing your money to work for you, not for a fund manager. So, our AI assessment is clear. For the vast majority of regular people building long-term wealth, stocks should be the undisputed foundation of their investment portfolio. This brings us to the most practical first step. Before you even think about riskier assets, look at your employer-sponsored retirement plan, like a 401k. If your employer offers a match, that is a 100% guaranteed return on your contribution. There is no other investment on earth that offers that. If you're not contributing enough to get your full employer match, you are leaving free money on the table. So before you buy a single stock, and certainly before you buy any crypto, make sure you are maxing out that match. It's the single best financial decision you can make to start your journey. Now, let's talk about the asset class that for generations has been synonymous with the American dream: real estate. For our parents and grandparents, owning property wasn't just about having a place to live. It was the primary engine for building lasting wealth. It was, and in many ways still is, seen as the most tangible and reliable path to financial security. But while the dream remains potent, the landscape has shifted dramatically. So, where does physical real estate fit into a modern investment portfolio? Especially when compared to the accessibility of the stock market. The allure of real estate is built on powerful, undeniable advantages. The most significant is leverage. Unlike stocks, you don't need the full purchase price up front. You can put down, say, 20% for a property, but you control 100% of the asset and benefit from 100% of its appreciation. Let's use simple math. On a $500,000 property, your down payment is $100,000. If that property's value increases by just 10% to $550,000, your $50,000 gain represents a staggering 50% return on your initial cash investment. That is the power of leverage in action. Then there are the tax benefits. Governments often incentivize property ownership. For your primary residence, you can typically deduct your mortgage interest. For investment properties, it gets even better. You can deduct operating expenses, and crucially, you can claim depreciation, an accounting tool that allows you to write off a portion of the property's cost over time, reducing your taxable income, even as the property itself is likely gaining value. And of course, there's cash flow. If you're a landlord, this is the rental income left in your pocket each month after the mortgage, taxes, insurance, and all other expenses are paid. It's the passive income stream that many investors dream of. However, the barriers to entry are substantial, and the risks are very real. The idyllic image of passive income often clashes with the reality of property management. That reality can mean late-night calls about broken toilets, chasing down late rent payments, and navigating complex tenant laws. It's often less of a passive investment and more of a part-time job. The financial hurdles are even higher. In today's market, the down payment alone can be a monumental sum, often requiring years, if not decades, to save. This brings us to the biggest drawback for many: liquidity. Your capital is tied up. Selling a property isn't like selling a stock. It's a slow, expensive process that can take months. Your wealth is not accessible on demand. So, what's the final assessment? Direct real estate investment makes sense under specific conditions. It's a powerful tool if you have the significant capital for a down payment and closing costs without overextending your finances, if you plan to stay in one geographical area for the long term, and if you have the time, skills, or additional capital to manage the property effectively. For those who meet these criteria, it can be an incredibly rewarding and wealth-building journey. But what if you want the benefits of real estate without becoming a landlord? There's an alternative: REITs, or real estate investment trusts. Think of a REIT as a company that owns and operates a portfolio of income-producing properties, office buildings, apartment complexes, shopping malls, data centers. When you buy a share of a REIT, you're buying a small piece of that vast portfolio. They are legally required to pay out at least 90% of their taxable income to shareholders as dividends, offering a steady income stream. Best of all, REITs are traded on stock exchanges just like any other stock. This gives you the exposure to the real estate market with the liquidity and low barrier to entry of the stock market. You can buy or sell in seconds, and you can start with just a few dollars, making it a far more accessible entry point for the modern investor. Crypto: highest risk, highest potential upside, shortest track record. AI assessment: appropriate as a 5-15% allocation of total investment portfolio for most people, rising to 20-25% for those with higher risk tolerance, longer time horizons, and stable income. The role of crypto in a portfolio: growth acceleration, not foundation. Stack your foundation in stocks and emergency savings first. The AI portfolio allocation framework, specific to your age and income level, is something I can walk through with you. Drop your age and rough income bracket in the comments and I'll give you the AI suggested breakdown. Subscribe for more cross-asset analysis like this.